All right. Why I avoid the S&P 500 in my investment strategy. Let's get right into it. When you're looking at how to build a portfolio, you get a lot of generic advice. A lot of people say just buy the S&P 500 and you're fine. There's a lot of videos of single index funds, single ETF portfolios, single fund portfolios that just track the S&P 500 index. It's a popular piece of advice and a common strategy, but hang out with me for a little bit. I'll show you the dark side of the S&P and why I'm taking a bit of a different approach with my portfolio here. So first, let's just jump into a little bit of what I mean by the S&P 500. It's an index. It's made up of the top 500 largest corporations by market cap. Generally, when someone says the market, what they're talking about is the S&P 500 index. 3 reasons why I'm not buying it are concentration, overexposure, and your risk to your retirement. So it's made up of 500 companies, and a significant portion of this value is driven by a small number of mega cap stocks. Amazon, Microsoft, Nvidia, things like that. You'll hear things like FANG and the Magnificent Seven. This is where most of the investment money right now is going, and it's leading to a really high PE ratio in these companies. So I took a screenshot earlier of Nvidia. You'll see the PE ratio down here, 75.72. So the company's trading at quite a premium right now. Goldman Sachs showed that this has happened before. I'll link this article down in the description so you can take a look at it and read it yourself. But there have been several times in our history where we have had concentration where most of the value was in just a small handful of companies. And you can see when this happens, there's a crash, a correction, and then the market has a bull run. The other reason is overexposure. When you're buying ETF, you're buying a specific investment strategy run by the ETF managers, and there's a basket of stock that they're using for that strategy in that ETF. The majority of the market's investments being placed into the same 10 companies does affect you if you're investing in ETFs. So this is pointed out here by a Motley Fool article, where they show an overlap between the Spider S&P 500 QQQ and the S&P 500 ETF trust, and you'll see there's a lot of overlap. So I went into Robinhood earlier and looked into this. So when ETFs put the same companies into the same basket for different strategies, even if you own all these diversified funds, your portfolio is still based just on those 10 companies. So let's break this down. So here we have VTI, SPY, the Motley Fool TMFC, VOO, and Invesco QQQ. And what you'll notice from these screenshots here, and let's get a good look at these two down here, totally different strategies, and they're made up almost of the exact same handful of stock. Oh no, my link. Okay, there we go. So you can see, even though you have a bunch of diversified funds with very different strategies, they're essentially holding the same things. Another reason why I'm not putting the majority, of my funds into the S&P 500 is that when your whole portfolio is based on 10 companies and only the S&P 500 index, a recession will destroy you. The majority of your value will evaporate. And if you happen to retire during a recession, and this is your whole core holdings, you're cooked. Polish off the old resume and just go back to work. So let's look at the 90-year historical chart of the S&P 500. This is the 2008 financial crisis right here. So if you had retired at any point between here and here at the bottom after the financial crisis, everything would have hit. Here was the drop in 2019 during COVID-19. If you retired here at this point, it takes years for your portfolio to recover. So here's 2010. Here's about like 2019. Here's 2020, and in 2008, you can see it took until about 2010 until you returned to back to where you were. So you can see why this is a huge risk to your retirement planning if you're holding solely single index, S&P 500 index funds as the majority fund of your portfolio. This is not to disparage the S&P 500. You can clearly see that long term, if you look at the charts and you do your research, it's a long-term winner, though you do run the risk of a recession eating your account overnight. The index is something that you hold long term, but still be careful not to have this as a major holding or your wholly single holding. So the concept of diversification also applies to owning diversified index funds. So if all you own is the market and the market tanks, you're going to tank with it. Thanks for stopping by. I'll see you next time.